Welcome to The Explainer. Today, we are diving deep into a really powerful story from Christopher Leonard's book, The Lords of Easy Money. It's a journey into the heart of our economy and the very small group of people who ended up in control.
You know, it's one of those big questions, right? Who's really pulling the strings? It's the kind of thing that hits home because it affects, well, everything. Our jobs, our savings, our future. And the answer this book presents, it might just surprise you.
So who are they? We're talking about the U.S. Central Bank, the Federal Reserve. Now, for a lot of us, that just sounds like some, boring government institution, right? But this book paints a totally different picture. A small group of people with an incredible amount of power over our financial lives. Okay, so to really get a grip on this, we've got to rewind the clock. Let's go back to 2008. The entire global economy is on the brink of collapse. Banks are failing. It looked like we were staring down another Great Depression. The Fed knew it had to do something, and something drastic. And what they came up with was this policy with a super technical, kind of intimidating name, quantitative easing. Let's just call it QE. And yeah, it sounds complicated, but the core idea? It was basically for the Fed to print a whole lot of money and pump it straight into the financial system. So how'd this massive experiment actually work? Well, it's basically a three-step process. Step one, the Fed just digitally creates trillions of dollars. Poof, out of thin air. Step two, it takes all that new cash and buys up massive amounts of bonds, mostly from the big banks. And the idea, the hope, was that these banks, now swimming in cash, would turn around and lend that money out, to get the economy moving again.
Okay, but here's the twist, and it's a big one. This absolute tidal wave of money, it didn't really rain down on everybody equally. What the book argues is that it basically split the economy in two. It created this starkly different reality for Wall Street versus, well, the rest of us on Main Street.
Just look at this. The money poured straight into the financial markets. So if you owned assets, stocks, real estate, things just went through the roof. But then you look at wages. For most working folks, that huge flood of money, it was barely a trickle. The difference is just staggering. So here's the bottom line. If you already had wealth, if you owned assets like stocks or property, you did incredibly well in the years after 2008. But if you earned your living from a paycheck, the benefits were a lot harder to find. In fact, for many, it just meant more insecurity. And that wealth gap between the two, it just got wider and wider.
Now, you might think everyone at the Fed was on board with this, but nope, not at all. Right inside the room where it was all happening, one person was consistently sounding the alarm, basically yelling, "Stop!"
That person was Thomas Hoenig. He was the president of the Kansas City Fed, so he was right there in the meetings, at the table where these monumental decisions were being made. And he just kept arguing that this whole easy money experiment was a huge mistake with some really dangerous strings attached.
And this quote from him really gets to the heart of it. He said he saw it as risky and not particularly fair. What he was really saying was that this wasn't about helping the average person. It was, in his words, a massive subsidy for the biggest banks and the wealthiest people. A bailout for the rich, plain and simple.
And his warnings were really specific. First, he said the Fed was messing with the natural market, completely distorting the price of money. Second, he warned about this thing called moral hazard, which is basically, if you keep saving the banks from their own bad decisions, why would they ever stop making them? And maybe most importantly, he predicted that all this was just creating huge, unsustainable bubbles that were bound to pop later on. And that's a perfect lead-in to the long-term consequences. Because the book's central argument is that in the rush to fix the 2008 crisis, the Fed might have accidentally created an even bigger problem. An entire economy built on a foundation of cheap debt and really risky behavior.
Just get a load of this number. Over $10 trillion. That's how much new debt U.S. corporations took on in the decade after the crisis. With interest rates at rock bottom, it was like a feeding frenzy. It's just an almost unimaginable amount of money.
So you're probably thinking, okay, where did all that borrowed cash go, right? Ideally, it would be used for productive stuff. Building new factories, funding R&D, maybe even paying workers more, but that's largely not what happened.
Instead, as the book shows, a ton of that cheap debt got funneled into things like stock buybacks. That's where a company uses borrowed money to buy its own stock just to make the share price go up. Great for shareholders and executives, but it doesn't really build anything. So, just like Honig warned, we ended up with an economy that looked great on paper, but was secretly becoming more and more fragile, totally hooked on the Fed's stimulus, and setting us up for future problems with inflation.
So that leaves us with the huge central question of this whole story. In trying to save us from one crisis back in 2008, did the Lords of Easy Money accidentally create the next one? Did they build a system that's more unequal, more fragile, and built on a mountain of debt? According to this book, the answer is yes. And it's a question we're all still grappling with the consequences of, every single day.